All right, welcome back. I will admit I'm pretty excited about this video. The lecture series is called The Value of Growth, and my goal has been from the very beginning is to show, introduce a new set of tools to help investors value growth. A new set meaning that no one else has done this. This is brand new tools that I've developed over the last couple of years. I started thinking about growth when I was a tech analyst in the 90s. I had the benefits, terrific opportunity to co-author a book with Jeff Moore called The Guerrilla Game. Jeff, as many of you know, wrote Crossing the Chasm, probably the best high-tech marketing book ever written. Jeff's a gem of a guy for what it's worth. Working with him was great. When we get to that segment, when I work closely with Jeff, I'll tell some funny stories about how he and I met. But I've been thinking about growth for a very long time and have felt strongly that there have been no tools provided in any of the academic or practitioner literature to help us take growth apart. And frankly, over the last couple of years, all post finishing up writing Pitch the Perfect Investment with Paul Sonkin, I've devoted a lot of time thinking about growth, and over the last couple of years developed some pretty cool tools. And it's really been the genesis of this video series is to introduce those tools. So here we are on episode 14, and we're going to talk about growth for the first time in a Value of Growth lecture series. So I'm pretty excited. This is really kind of the introduction, and from here on out, we'll spend a lot of time on growth. We will do a pit stop and talk a little bit about competitive advantage, and then we'll dive in fully on growth. But today will be the beginning of our adding growth to the overall discussion. So I'm excited. All right, at the end of the last lecture, I split or created what I like to think about as the valuation stack. And this sets us up for valuing growth, which was the first layer of that valuation was invested capital. All companies should be worth their invested capital. All companies should, in theory, earn their cost of capital, minimum earn their cost of capital. Now, if a company is not earning its cost of capital, then its cash flow value, earnings power value, will be less than its invested capital. We saw that on the energy drink example from last week, where the cash flow value, the value of the NOPAT, the cash flows, earnings power, was 80 million against an invested capital of 100 million, and that's because it only generated an 8% return on invested capital against a 10% cost of capital. Now, the attractive case and of the three cases was hard kombucha, where you saw what we showed was NOPAT would be 25 million, a capital charge of 10 million, excess return in dollars of 15 million, and that translated into a valuation stack that had earnings power value, the value of those NOPAT. That NOPAT was 250 million. Invested capital was 100 million, and the present value of competitive advantage was 150 million, as we showed. And then we compared all three of the investment opportunities, and you could just see earnings power value for craft beer was 100 million. Company earned its cost of capital, therefore the cash flow value is equal to the invested capital. I spoke moments ago about energy drink. The cash flow value was less than invested capital. And in hard kombucha, the cash flow value, because of those excess returns, was greater than invested capital. So that's really the setup. That's the beginning of the valuation stack. All right, we talked about it graphically like this. This is NOPAT. It's the same as earnings power. Flip that to the outside. Add duration, which because we're assuming that earnings power will be constant over time, we can use the perpetuity valuation formula, which then means that our earnings power value is effectively the area of the rectangle, which is kind of cool. All right, so that's your earnings power value, as we just pointed out. There's your invested capital. There's that second layer of the valuation stack, which is the present value of competitive advantage. I'm going to talk more about that when we get into competitive advantage. But for the moment, we're going to assume that the company has a sustainable competitive advantage, and therefore that light blue or I guess we'll call that sky blue layer, will hold and be steady. All right. So that's our valuation stack. That's the beginning of it. And this is the value that is potentially at risk because it's that layer, that excess returns that are going to attract potential competitors. It's going to signal to them that invest a certain amount of money and create a business that generates cash flow worth more than the invested capital. So that's why that value at risk, that's a value at risk. All right, so now we're effectively going to go to the third layer of our valuation stack, which obviously is going to be growth. That's the missing piece. And I just want to walk you through the logic of how we set that up. All right, we know the enterprise value is the equity market value plus the market value of debt plus excess cash and some other things. I'm going to keep it pretty simple. And the focus really here is on the market value of equity. That is what is dictated by the market. That is effectively your share price is going to dictate your market value of equity. All right, that I'm going to point that out because we're going to come back to that. All right, so the present value, enterprise value is the present value of all future cash flows. It's the market's estimate of value. I say that again and again. Price is effectively the consensus estimate of value. Price is the consensus estimate of the present value of all future cash flows. That's what price is. And price changes when those expectations change. So your enterprise value is the present value of all future cash flows. That's the important comment. And it is essentially the consensus estimate of the present value of all future cash flows. And that's going to be really important when we get into the growth component. To remember, it's the consensus estimate of future cash flows. All right, now earnings power value, which we've talked a lot about in this video series, is NOPAT divided by R. We're using the perpetuity valuation formula because we're assuming NOPAT, earnings power, same thing, is going to be steady over time. And that's that sky blue layer we were just talking about. All right, so that is, earnings power value is defined as a steady state, no growth value of cash flows, right? So no growth being the key phrase. All right, now if we take enterprise value, which is the present value of market's estimate, present value, all future cash flows, and we subtract from that earnings power value, what are we left with? When asked the question again, enterprise value, which is the value of all cash flows, it's the market consensus estimate of all cash flows, and we're subtracting from that the steady state, no growth value. We're obviously left with a phrase I like to call, and we'll use this the rest of the lecture series, the market-implied value of growth, MIVoG. And it's very important to understand that this is the value of NOPAT growth, the market-implied value of NOPAT growth. So this is essentially a present value of all of the growth, all of the cash flows that come from growth. And as I talked about a moment ago, this is the market-implied value. This is the consensus estimate value of growth. And in a moment, we're going to look at the S&P 500 with these tools, and just keep that in mind. That's what investors are estimating the future value of cash flows, NOPAT, from growth. Really important. But that's what you're paying for. That's what you're paying for. And part of the game of investing is understanding investor expectations. As we get deeper into the value of growth, you'll see that what I'm trying to do is tease out, and I think we have tools that can do this now, tease out what investor expectation is for growth. I mean, I don't know. I think it's really cool. I hope you feel the same way. All right, so there's your invested capital. There's your present value of competitive advantage. That's effectively your earnings power value. Now we're going to add the market implied value of growth. So this is our full valuation stack. The green line essentially is enterprise value. The blue and red added together is your earnings power value. The difference between your enterprise value and your earnings power value is that market implied value of growth. All right, let's take these tools now and just apply them to the S&P 500. See what they show us. All right, there's your earnings per share for the S&P 500. This is my proxy for NOPAT. I don't have a bet. I don't have NOPAT for the S&P 500. I'm sure it's available, but EPS is pretty straightforward. All right, so now here's the fun part. Here is green and blue. Now, I also don't have invested capital for the S&P 500. partially because you have financials in there and they kind of mess up the invested capital. So I only have here is earnings power value, blue, and market implied value of growth, green. And that's for the S&P 500 for the last almost 15 years, which I think is pretty cool. I don't know. When I first drew this chart, this is a current version of the chart, but when I first drew this chart a couple of years ago, I was pretty blown away because I don't think anybody's ever looked at the S&P 500 separating out an earnings power value and a growth value. And we're going to play with this a lot. From here on in, this is going to be one of our primary tools. All right, so there's earnings. So it's the same chart. Here's earnings power value alone. And what you can see is actually the last couple of years, it hasn't done much. It's gone sideways. Interestingly, partially because rates came down, it went up a fair amount in 21 and early 22, which you see that a bit of a bump there. But earnings per value has been fairly steady now for a little while, a couple of years. All right, there is your market implied value of growth, separated from, that's the green, just on its own scale. And you can see that this is kind of cool. Back in 11 and 12, you were paying nothing for growth, which is pretty amazing. And you can see now we're paying a lot for growth. So the world's really changed in the last 10 or 12 years. At one point, we paid almost nothing for growth. And then now we're paying a lot for growth. Now, the question, of course, is how much is a lot? All right, so here's your earnings power value as a percent of enterprise value, going back for the same time series, now 15 years. And you can see that as of right now, earnings power value as a percent of the S&P 500 is down to 36%. It 10-year average is about 55%. 5-year average is just above 50%, 51%. So we're well below both the 10-year and the 5-year average. So, which means, by definition, we're paying a lot for growth as a percentage, not just as an absolute, but as a percentage. All right, so there's the same earnings power value, exactly the same chart. I just put it in a bar chart, and then that's always going to be blue. And so you just see same numbers we saw in the earlier chart. I just changed it to a stack, a bar chart, because when we start looking at companies, I'm going to use a bar chart rather than a line chart. All right, well, the inverse as a percent clearly has to be growth. So here's your market implied value of growth as a percentage of the S&P 500 enterprise value. And you can see we're at 64%. 5-year average is just under 50%. 10-year average is sort of 45%. Obviously, it mirrors the earnings power value. So we're at the highest market implied value growth, the highest it's been in 15 years. Now, I'd like to go further back, but '08 and the financial crisis blows up the chart because of that mixture. So I'm trying to put some numbers together before '08. Preliminary data suggests that this is the highest we've had in 25 years. I'll come back to that. Other people may want to do the work. The second thing I'm working on now is pull out the Mag 7 and look at the S&P 500 separated from the Mag 7. Once I have that done, I'll pop on a new video. All right, so there's that, what we saw earlier, the 11-12 period, paying nothing for growth. Pretty amazing. And then this was the peak in 2020. Market hit an all-time high in October 2020. You see that. But what's interesting is we're actually higher now as a percentage of enterprise value. It's the highest it's been. So market's quite optimistic. Now, I tend to think in investor expectation. I'm not going to say anything like market's overvalued, market's undervalued, because I don't think that terminology is very helpful. What I will say is growth expectations are high or low. So if we go back here, growth expectations in 2011, 2012 were incredibly low. And then both in October of 2020 and now, growth expectations are very high. Doesn't mean they're wrong, it's just they're very high. And then once again, I'm going to always use a stack. Well, you'll see it's stacked in a minute. I'm going to use a bar chart for all of my company analysis, which we will do. We have to do a bit more laying out the tools, and then I'll do a couple of case studies. We'll do a case study on Chipotle. We'll do a case study on Shake Shack and Uber, and then ultimately a case study on NVIDIA and Apple, using just these tools, all separated. All right, so that's kind of the series. Now this is quarterly in a bar chart. This is what it looks like annually. This is my stack bar chart. This is the valuation stack in a bar chart, and this is for the S&P 500 annually. This is what it's going to look like for the company. So I just wanted to convert it to that. All right, that's essentially the intro lecture to growth. We're adding growth to our valuation stack, and we're going to look at earnings power value against market implied value of growth. We're going to look at that on a historical time series basis. We're going to ask the question is how much is too much? In the next lecture, I'm going to develop these tools a bit more, show you how we can tease out implied growth rates from these formulas, but I'll keep that for the next lecture. All right, I think that's it. Yep, that's it. Thank you very much. See you in the next lecture.